Welcome to Talk Tickers. We're your shortcut for digging into what really matters in earnings calls. Today, we are diving into American Financial Group, ticker AFG, and their Q3 2025 results. They dropped just after the bell on November 4th. And honestly, if you want a case study in disciplined specialty insurance, this is pretty much it.
Oh, absolutely. The market reaction told you a lot, didn't it? That higher trading volume. People noticed this wasn't just, a simple beat. It was kind of a masterclass in how they run their specialty P&C playbook. We saw what I'd call a really clean underwriting quarter. It confirmed their strategy works. And the big news, that capital action, the special dividend, we'll get into that, really cemented, I think, a bullish view on their capital generation.
Okay, yeah, let's hit those headlines then. The beat was definitely strong. Core operating EPS, that's a non-GAAP figure, landed at $2.69. That just sailed past the consensus estimates, which were around $2.48, maybe $2.51.
Yeah, easily beat them. That kind of outperformance, it says a lot about the core profitability.
So where's that profit coming from?
It's the engine room, right? The underwriting. Underwriting profit itself jumped to 19% compared to Q3 last year. And if you annualize their core operating return on equity, their ROE, it was running at about 19%.
Wow. 19% ROE in P&C. That's really top-tier stuff. Yeah. Shows they're putting shareholder money to work effectively.
Exactly. It's a benchmark, really.
And the top line looked good, too. Revenue beat expectations as well.
It did. Total revenue landed somewhere between, say, $2.2 billion and $2.33 billion. The street was thinking more like $2.17 billion. So, yeah, top line, bottom line, return metrics, all pointing in the right direction.
Okay, so how did they pull it off? Let's get into the nitty-gritty, the core specialty P&C segment. What did that look like?
Right, the combined ratio. That's the magic number in insurance. It came in at a very strong 93.0%.
Okay, maybe unpack that 93.0% a bit for listeners who aren't insurance nerds. Why is that so good?
Sure. Simply put, it measures how much they paid out in claims and expenses for every dollar of premium they brought in. So anything under 100% means they made money just from writing the policies, even before investment income. A 93.0% means they kept 7 cents of every premium dollar purely as underwriting profit. That's solid margin.
And that's better than last year.
Yep. An improvement of 1.3 points or 130 basis points year over year, real margin expansion.
And importantly, it wasn't just luck with, say, fewer hurricanes this quarter.
Well, catastrophe losses were low, definitely. Only at about 0.4 to maybe 1.2 points, depending on the specific line. Much lower than last year.
Okay.
But no, the real story here is deliberate action. It's about pricing power and rate adequacy. Management really hammered this point. Overall, renewal pricing across all their P&C lines was up 5%.
5%. Okay.
But wait, that includes workers' comp, which tends to be a softer market. If you pull workers' comp out of the mix, that average rate increase jumps closer to 8%.
8% excluding workers' comp. That's a significant number.
Yeah.
And management felt this was actually outpacing loss trends, getting ahead of inflation.
That's a key takeaway, exactly. When your rate increases are running hotter than your expected claims inflation, that difference drops right to the bottom line. It builds a buffer.
Makes sense.
And look at the really tough lines, the ones most exposed to, say, litigation risk, commercial auto. Rates there were up around 11%.
11% on commercial auto. Okay. And what about those areas really hit by social inflation? Things like social services liability or excess liability.
Yeah, they achieved what management called real rate increases in the mid-teens just in the last quarter.
Mid-teens.
Wow.
That's not just keeping pace. That's actively demanding much higher prices for taking on that risk.
It absolutely is. And this connects to a really telling detail they shared about risk management. They highlighted one specific large excess liability book of business. Now listen to this. Over the past 5 years, they cut the total amount of coverage they offer the aggregate limits by 25%.
Okay, reduce their exposure.
While more than doubling the premium they charged for that reduced coverage, mostly through rate hikes.
Doubling the premium while cutting the risk.
Exactly, surgical. They're shrinking the potential for massive social inflation losses, but making way more profit on the risk they do keep. They're not just running away, they're completely resetting the term.
That's incredibly disciplined underwriting right there.
Yeah. Okay, but we do need to touch on something that might have looked a bit off at first glance. Gross and net written premiums were actually down slightly, 2% and 4%. How does that square with strong pricing?
Right, that caused a few double takes initially. But it's mostly a technical thing, almost entirely down to the crop insurance business. It's just timing. The way crop acreage gets reported shifted some premium recognition from Q3 into Q2 this year. It's an accounting quirk.
Ah, okay. So if you adjust for that.
If you adjust for that, yeah. Excluding the crop business, gross written premiums actually grew by 3%.
Got it. So the underlying growth, stripping out that timing issue, is still there.
It is. The organic engine's humming along just fine. Okay, let's shift gears to capital. Because, wow, did they send a signal here? A $2 per share special dividend. That's a big number.
Huge. Payable November 26th, record date November 17th, works out to about $167 million going back to shareholders just from this one action.
And this isn't out of the blue, is it? It fits their pattern.
Not at all. It builds right on top of the regular quarterly dividend, which, remember, they already hiked to $0.88 back in August, and management was very clear. They expect operations to keep churning out significant excess capital into 2026.
Which gives them options.
Exactly. Flexibility for more special dividends, maybe buybacks, maybe even snapping up some acquisitions if the price is right.
And that $2 special, put that in context. How much have they returned this way recently?
It's pretty staggering. Since the start of 2021, AFG has paid out $54 per share in special dividends alone.
$54 a share.
Yeah. That's about $4.6 billion total. This isn't an occasional treat. It's a core part of how they return value.
Okay, let's look at the other side of the balance sheet, the investment portfolio. How's that looking?
Solid. Total cash and investments are sitting at $16.7 billion. And the income from that portfolio, the net investment income, was up 5% year over year.
What's driving that increase?
Two main things, really. Higher interest rates, obviously, but also just having more money invested overall.
Now, for people worried about rising rates hurting bond values, what's AFG doing with their fixed income portfolio? I saw the duration was quite short.
Very short, intentionally so. The duration on their fixed maturity portfolio is only 2.7 years.
Why keep it so short right now?
It's about playing offense and defense. Short duration minimizes the price swings if rates move further. But more importantly, it lets them reinvest cash from maturing bonds much faster into today's higher yields. They mentioned new fixed income investments are yielding around 5.25%.
Ah, so they're locking in higher income streams for the future as older, lower yielding bonds mature.
Precisely, capturing those higher rates quickly.
What about the alternative investments, the stuff beyond plain bonds and stocks? How did that perform?
Returns there were 6.2% for the quarter, which is decent, you know?
But they expect more long term.
Oh, yeah. Their long-term target for alts is 10% or better. And they gave some interesting color on their multifamily real estate holdings, which are a big chunk of that alt portfolio.
What did they say? Seeing stress there?
They acknowledged the current environment, but actually projected a recovery in that segment by the end of 2026.
Based on what? Wishful thinking.
No, they tied it to specific market dynamics. They pointed to declining new housing construction starts. Their thinking is fewer new buildings means tighter supply down the road, which should help occupancy and rents, boosting the value of their existing properties.
Interesting. Okay, connecting this all back. Underwriting discipline, strong capital. How does this shape their forward look? We saw amazing results in the specialty financial group, 81.1 combined. That's stellar.
Just phenomenal execution there. Shows what happens when you're highly specialized and know your niche risks inside out. But it does raise that question we touched on earlier. If you're cutting back exposure in some areas, like that excess liability example.
Right, shrinking limits.
How do you keep growing the top line overall? Doesn't that risk shrinking the business?
Yeah, that's the balancing act, isn't it? How did management explain the path forward?
Two key things. First, they expect margins to remain pretty stable because they feel they've achieved rate adequacy now. The pricing is where it needs to be.
Okay, stable margins.
Second, they're forecasting a premium growth rebound in 2026.
A rebound. From where?
Well, partly from existing specialty lines, potentially regaining some volume as market conditions maybe normalize a bit. But maybe more crucially, they highlighted momentum from new business units that they've started internally, like from scratch.
Ah, so internal startups are expected to kick in.
Yeah, seems like they're planting seeds in new specialty areas now, expecting them to contribute meaningfully by 2026. It's about replacing the premium they carefully shed in one area with disciplined, profitable growth in another.
Makes sense. Diversifying the growth sources.
Right. And even in a tough line like workers' comp, they noted things are firming up. Pointed to California specifically, where a recent 11% rate increase suggests even challenging markets might be turning.
Okay, this whole picture, the discipline, the capital return, the forward plan, it tees things up nicely for our next segment, doesn't it?
It does. But first, the necessary disclaimer. Remember, everyone, what we're about to discuss is purely hypothetical. It's for discussion and entertainment only, definitely not financial advice. We're just playing with the numbers and ideas from the call.
Got it. Okay, the stock's trading, what, just above $143,
Hmm.
but that 52-week high is up there at $140.19, not too far off. And you've got this huge $2 special dividend as a sign of confidence, plus that underlying 19% core ROE humming away.
Strong fundamentals, clear capital return signal. So what's the outrageous but plausible idea based on all this?
We're calling it the dividend capture ROE expansion combo.
Okay, break that down. Combo trade.
Part one is the short-term play, the dividend capture. You'd look to buy shares before the November 17th ex-dividend date to grab that $2 payout. Simple enough.
But dividend capture plays can be volatile right after the payout, right? The stock often drops by the dividend amount.
Exactly, which brings us to the hedge component. To mitigate that post-dividend dip risk,
You do what?
you could simultaneously sell some out-of-the-money put options, maybe expiring in December.
Selling puts. So you collect premium upfront.
Right, that premium income helps cushion any potential drop after the dividend is paid, but importantly, it doesn't cap your upside if the stock rallies.
Okay, so that's the short-term capture and hedge. What's the ROE expansion part, the longer thesis?
That's the core bet. It relies on the stock grinding higher and maybe retesting that $150.19 high by year-end or early next. The drivers? That sustained 19% ROE showing fundamental strength, and the market starting to price in that anticipated 2026 premium growth rebound we talked about.
So it's layering a tactical dividend play onto a fundamental view about continued profitability and accelerating growth.
Pretty much. A way to potentially juice returns while using options to manage some of the short-term risk. Again, not advice, just an idea sparked by the call.
Got it. Okay, stepping back from the trade idea, what's the big picture takeaway on AFG's long-term story?
I think it boils down to two core drivers of value creation for them. First, compounding their book value per share through profitable underwriting and smart investments. And second, layering on those significant, almost episodic special dividends. That's the formula.
Underpinned by that rock-solid specialty underwriting discipline and pretty opportunistic investment management, it seems.
Yeah, quite a quarter. To recap, big EPS beat, revenue beat, that strong 93.0% combined ratio really stands out.
And that confidence signal from the $2 special dividend, can't ignore that.
And remember, the way AFG likely wants you to track their total value creation is by looking at the growth in book value per share, but excluding AOCI.
Right. Accumulated other comprehensive income. That strips out the temporary swings from unrealized investment gains or losses.
Yeah.
Gives a cleaner operating picture.
Exactly. And that core metric, book value growth, plus the dividends paid out that reached nearly 11% just for the first 9 months of 2025.
11% in 9 months. That's generating serious value.
Really is.
So here's a final thought to leave you with, something to mull over. Given how confident management sounds about their pricing and seeing them strategically lean back into profitability in some of those tougher lines, could that 2026 premium growth rebound they're projecting actually turn out to be conservative? And if it is, what might that imply for even more capital return or other actions down the line?
That is definitely something to think about as we head towards 2026. That wraps up our deep dive on AFG's Q3 earnings.